Hey investors, Young Investor Guy here. In this video, I'm going to walk you through the basics of reading a stock's ratios, metrics, and data from a financial data website. I remember when I first started investing in the stock market, I was overwhelmed by all the data that's available out there. Many beginning investors don't bother looking at stats, data, or ratio, and often end up investing in the wrong stock. Or they sometimes don't really even know why they're invested in that stock. This can create a bit of a panic and fear when the stock price starts to go south. The smart investors do not panic when prices go south. This is because they're familiar with the financial stats, data, and metrics, so when things happen, they can actually end up making more strategic moves to build up on their position. If you're buying stocks and you would like to make more informed decision based on a stock's stats, financials, data, and metrics, then this video is for you. Please don't forget to hit that like button, and I thank you for your support. So without further ado, let's get started. There are many free resources available, and you can find many useful stats and ratios on the particular stock you like. In this example, we can use the website FinViz to go through each stat one by one. I'm going to pick a stock everyone's familiar with in this example, and that stock is Facebook. So like most of the financial websites, when you arrive at the stock page, you're expected to see the stock price, its chart, some of the latest news, as well as some stats and ratios. Our focus in this video will just be on the ratios and the stats. We're going to start from the top and all the way to the bottom so you know what each box means exactly. Different websites will have different structure, so they may have more or less of the information, but the essentials will be here. Okay, the first box is index, and we see S&P 500 here. So this means that Facebook is part of the S&P 500 index. The S&P 500 is an index that takes the average of all the performance of the largest companies in the US from different industries. You may have industries like financials, tech, healthcare, industrial, energy, communications, utilities, consumer cyclical, as well as real estate. In Facebook's case, it represents the communication services sector. In Microsoft's case, it may represent the tech sector. Or you might have Johnson & Johnson, in that case, it will represent the healthcare sector. It is important to pay attention to each sector so you know exactly on each day which sectors are doing well and which sectors are not doing well. The second box is market cap. Market cap is essentially how much the stock is worth. It is calculated by multiplying the current market stock price by the number of shares outstanding. Many investors beginning to invest may have a question like, why is a burrito company like Chipotle worth more than a company like Facebook? And this is because a company like Chipotle has fewer shares outstanding, whereas Facebook has more shares outstanding in the public. From the screenshot, you can see that Chipotle Mexican Grill has 27.89 million shares outstanding at the current price of $990. When you multiply the two, you get $27.61 billion in market value. Compared to Facebook's $652 billion market valuation, you understand that it is important to compare the valuation rather than just the stock price. Next box, we have income. And income is pretty self-explanatory. It is basically how much the company makes at the end of the day after subtracting all the operating expenses from the revenue. This is also the company's profit. Many companies nowadays report a lot of revenue, but they don't report profit. And to get more information on that, you would actually have to go to the company's financial statement and dig further and see why they're not reporting profit just yet. Sales is basically how much the company makes, also called revenue. The more the revenue, the better the company is doing. You can also compare the company's past few years and quarters of data, and you'll be able to see whether the company is growing or it is not growing. For example, if we were to look at Facebook's revenue stats, we know that this company is growing exponentially. Next, we have book per share. Book per share basically means book value per share. To understand what this means, you need to know what book value means. A stock's book value tells investors how much the company is worth after selling all its assets and paying all its liabilities. You can just remember it as cleaning house dollar value after the company gets rid of everything. So the book value per share formula is total asset minus total liabilities minus preferred equity divided by total outstanding shares. There's preferred equity in there that needs to be subtracted because preferred shareholders will have higher claims than common shareholders when the company needs to liquidate their assets. So subtracting it will actually have a more accurate picture of what's left for common shareholders. Let's now walk through an example with Facebook. So Facebook currently has a book value of 36.94 at the time of the video. This means when Facebook liquidates itself and sell all their assets and pay all their liabilities, how much is left per share? The book value data has already been calculated and interpreted for you, but if you're interested in knowing how we got this number, you would go into Facebook's financial statement. So if we go to Facebook's financials, we'll see that Facebook's total asset is 138 billion, and its total liabilities is 33 billion. And when we subtract these, we are left with $105 billion roughly, and that is the shareholders' equity. Now I believe Facebook doesn't have preferred shares, so we can leave that out of the formula. At the moment, Facebook has 2.85 billion shares outstanding. So when we divide the 105 billion by the 2.85 billion, we're left with 36.94, which is the number you're seeing here. Many value investors pay attention to book value, and they scoop up undervalued shares when they get a chance. For example, Southwest Airlines currently has a book value of $17.62. When the stock traded close to the $20 mark, many value investors jumped in and purchased the stock. The next stat we want to look at is cash per share. As you can expect, this metric measures a company's cash position relative to the shares out there. This also tells you at what share price the company has available to pay all its liabilities, and most importantly, telling you how liquid the stock is. The formula for this is cash plus cash equivalents plus short-term investments divided by total shares outstanding. Again, this number has already been computed for you, but if you're interested in knowing how we got this number, you would go to the company's balance sheet. And let's use Facebook as an example again. If you go to Facebook's balance sheet, you'll see they have a total cash position of 60.289 billion. And again, the total shares outstanding is 2.85 billion. When we divide the 60.29 by the 2.85 billion, we're left with around 21.15. And this is pretty similar to the number you're seeing here on the screen, but sometimes the numbers might be not exactly the same due to rounding and decimal issues. Let's also use cash per share as another example for casino stocks. If you look at a casino stock like MGM, the stock has a cash per share at around $12. This means that MGM has a lot of cash to leverage, like paying off any debt or short-term obligations. Since MGM is trading not too far from the $12 mark, you know that in situations like this, value investors will jump in and buy the stock. The next stat we have is dividend. But since Facebook doesn't pay out a dividend, we can look at a different company instead. Let's look at Microsoft here as an example. The number you see here is the dollar Microsoft will pay you for each share you have. So if you have one share of Microsoft, Microsoft will pay you $2.04 annually. Now, if you buy a financially strong company, you can expect this dividend amount to go up gradually over the years. If we also look at Microsoft's past dividend history, we know that the company has also been increasing its dividend throughout the years, and that's also an indication that the stock is doing well. Dividend percent is the amount in percentages you can expect to get when you invest in the company. So a 1.12% means if you invest $100 in Microsoft, you can expect to get $1.12. But most investors investing in Microsoft aren't really investing it for the dividend, they're investing more for the growth. Okay, let's go back to Facebook. Next box we have employees, and this just tells you the number of employees they have working at the company. Optionable, this will say yes or no. Most of the stocks you see will say yes, and for beginners trading options, this is not the best place to start. When you hear people talking about they're buying calls or buying puts, they're referring to options. And this game is called options because it gives you as an investor the option to buy or sell a stock at a predetermined price at a future date. This is more speculative rather than investing, and we can save this whole topic for another video for another day. Shortable means whether you can sell the stock short or not. The stock market has three directions. You can move up, you can move down, or you can move sideways. When someone believes a stock will go up, they're said to be going on the long position. When someone believes a stock is going down, they can take a short position. Recommendation. This number is the average analyst's recommended score on a scale of 1 to 5, with 1 meaning strong buy and 5 meaning strong sell. Facebook currently has an average score of 1.9, which means analysts on average are still encouraging people to buy the Facebook stock. Now, it doesn't necessarily mean that these guys are always right and you should just go there and buy the stock, but the number kind of acts as a reference so you kind of know what the sentiment is on the street. The next box is PE ratio. You may hear this one a lot, and it's one of the fundamental ratios investors use to value a company. The formula is simply price divided by earnings per share. If Facebook's current price is $220.14 and its EPS is $6.95, by dividing these two numbers together, you end up with $32.97. Now again, the number might not look exactly the same with what you see here, but they're going to be fairly close. To understand whether this PE is a good number or a bad number, you can look at two things. One, compare this number with its peers in the same industry. Now Facebook rules social media, so it's kind of difficult to take a direct comparison. But if you're investing, say, in a company like banks, you can also compare the different banks to see if they vary. Number two, compare this number with the company's past valuations to see what multiple it was trading at. Was the PE ratio higher or lower now than the 5-year average? You can also think of PE ratio as how much investors are willing to pay for $1 in the company's earnings. So in this case, investors are paying about $33 for $1 in Facebook's earnings. Okay, moving on, we have forward PE. Now, forward PE is the same concept as PE, but it's based off the company's forecasted EPS. Now, during uncertainties, you may hear in the news that companies have decided to withdraw guidance and pull their guidance. When this happens, the forward PE ratio will no longer be accurate. If forward PE ratio is lower than the current PE, it means earnings are expected to increase. If forward PE is higher than current PE, it means earnings are expected to decrease. Next, we have the PEG ratio. The PEG ratio is this price to earnings to growth, factoring the growth. You can think of PE ratio as a normal hamburger, and you can think of PEG ratio as the cheeseburger with the extra cheese. The way to calculate PEG ratio is using the PE ratio divided by the EPS growth. Now, traditionally, it was a hassle to calculate this because you would actually have to go out and find the company's growth rate and then compute the EPS. But nowadays, everything has been laid out for you, so you just have to read and interpret the number. PEG ratio is essentially just PE ratio, but you're also factoring in the growth, so you get a better, broader picture about how the company is doing relative to its growth. Theoretically, if the PEG ratio is 1, it means the PE ratio is in line with the growth rate. If you have a higher number, it means the price you're paying for is outpacing its growth. Let's say the PE ratio of a company is 20 and is growing at 5%. When you do 20 divided by 5, you get a PEG ratio of 4. So this means that it's only growing at 5%, but you're paying 20 times earnings. It is also good to compare this number with similar companies in the industry. In Facebook's case, Facebook has a PE ratio around 33 times and also has a growth rate around 16.5%. And when you do 33 divided by 16.5, you're left with a PEG ratio at around 2, which is not too bad. After PEG ratio, we have the price to sales ratio. So price to sales ratio is a ratio that measures a company's stock price relative to its sales or revenue. The formula for this is price divided by sales per share. So again, if we use Facebook as an example, we would take Facebook's current price and divide it by its sales per share. So this number will tell you essentially how much investors are paying for $1 revenue that Facebook is getting. So in this case, investors are paying $8.90 for $1 in Facebook sales. For companies that are not profitable, they won't have a PE ratio, but we can at least look at the price to sales ratio to kind of at least know how much in their sales they're generating and how much we're paying for it. Next, we have price to book. So the price to book value measures a stock's current market value relative to its book value. Remember the book value we did earlier? And book value is the company's total asset minus total liabilities. And it's essentially what the company will have left after cleaning house. Normally, a number under 3 is considered good, and since it's around 6 times, it's a little rich. P to C is price to cash per share. And this is focusing on the company's current price relative to its operating cash flow per share. The formula is price divided by operating cash flow per share, where P is the current market price and operating cash flow is the money coming in from operations, so you know that's the amount that company is making from operations. Some investors favor this metric more than the PE ratio because it only focuses on the cash flow. Whereas in the PE ratio, you're talking about earnings, and that also includes stuff like depreciation, amortization, and all these things where accountants can actually manipulate these numbers. The low number here can mean the stock is undervalued compared to its peers, meaning they're doing well in operations generating cash. And the high number can mean the stock may be overvalued compared to its peers. In my opinion, anything generally below 15 means they're currently doing pretty well. The next ratio is the P over FCF ratio, which is the price to free cash flow ratio. Now keep in mind the one we just discussed is for operating cash flow, where this ratio focuses on free cash flow. And the formula for this is market cap divided by free cash flow. This is a more accurate measure of cash flow because the previous price divided by cash flow only focuses on the operating cash flow, whereas this focuses on free cash flow after subtracting capex, which is capital expenses. And this is a number to look at when the company is looking to expand its business or utilize its cash. And if we take a Facebook's example here, we take its market cap and divide by its free cash flow, we get 27.74. Similar to other ratios, you would use this number and compare it to other companies in the same industry. Okay, I know that's a lot of numbers and ratios to digest, so I'm going to stop right here. For the people interested in continuing, I will be releasing a part 2 of the video that finishes off the other ratios. Now, I hope this video will help you familiarize yourself with all the different ratios out there and help you make better informed decisions. As always, please be sure to give this video a like if you found the content helpful. Thanks again so much for watching. I appreciate it, and I'll see you guys next time.